In this video, I'm going to explain how potential buyers of your business will determine the value of it. In order to do this, I will need to explain some concepts beforehand so that you will better understand how this is done by the end of the video. I will also show you that there are two things you need to do to exponentially increase the value of your business. This will become clear as you gain an understanding of how buyers determine the value of your business. Now, many business owners think that the best way to increase the value of your business is to increase sales or profits. Some business owners have already figured out that the increased sales doesn't necessarily mean increased profits. But what they still don't know is that increasing profits, or better, increasing cash flow, is only half of the equation. You might be surprised to find out that every business has a range of values. One of the reasons for that range of values depends on who will be taking over the business. The business may be transferred internally to family or employees, or maybe a management team, or it may be transferred externally to a financial buyer or a strategic buyer. Each of these buyers will see a different value of your business. This range of values might look something like this. The owner value is what the owner thinks it's worth, which is often exaggerated. I even had an example of when I was sitting down with a client who was looking at buying a business. The seller of the business said a certain value, and I asked, well, how did you determine that value? And that person said that they had asked their personal financial planner how much they needed to retire, and thus that was the amount they wanted for the sale of their business. That's not necessarily the true value of the business. For example, when you look at family or employees, it needs to transfer at what's called fair market value. Fair market value is the price at which the property or the business would change hands between a willing buyer and a willing seller when the buyer is not under any compulsion to buy and the seller is not under any compulsion to sell, but both have a reasonable knowledge of the relevant facts. Contrast that with a strategic buyer who would pay more because they see synergies in combining their business with your business, thus increasing the performance of the combined firm over the sum of the two businesses separately. These synergistic benefits may come in the form of increased revenue, cost reduction, process improvement, economies of scale, and/or overall risk reduction. Buyers of businesses usually pay a premium for companies with consistent and predictable performances, companies that perform well in down economies, companies that outperform their industry, and companies that have an upward trend in performance over time. When a chartered business valuator determines the value of a business, they look at it three different ways. First, they determine the market value of the net assets. Second, they look to see what businesses like yours are selling for on the market. And finally, the third method, which I'll get into more into this video, is the net present value of cash flow. They then determine the value of the business after considering the results of these three different methods. To set the stage at determining the net present value of cash flow for a business, I need to talk about risk versus return. When you invest in very safe investments, you can expect to earn a low return. Nowadays, money market funds or GICs are earning about 4%. If you invest in stocks on the stock market, you can expect that you will receive a return of about 10% in the long run. When it comes to private businesses, investors will consider the riskiness of each business. If it is a mature business and they consider the business to have a low risk, they will look for a return of 17%. When I talk about low risk with regards to the present value of cash flow, I mean that investors will think that the cash flow is very likely to continue into the future. If investors think that there is a high risk of the cash continuing into the future, then they're going to want a higher return on their investment in that business, and they will want a 35% return. If you are talking about a business in the early stage, investors will want 35% just for a low risk investment or a low risk early stage business, and they will want even 60% for a high risk early stage business. To help you to understand present value of cash flow, imagine that you have $100 that you'll receive a year from now. Think about whether that $100 a year from now is the same as having $100 today. The answer is likely no. It is not the same because you could have used that money for something else or invested it to earn more. Present value is a way to figure out how much that future $100 is worth in today's terms. It considers the time value of money, which means money today is generally more valuable than the same amount in the future. So, the present value of cash flow is the current worth of the future sum of money, considering the time it takes to receive it, and the potential to earn a return. It helps to compare the value of the money at different points in time. For example, if you could invest $90 today and get $100 a year from now, the present value of the future $100 is $90. Now let's apply that to determining the value of a business. Remember, the greater the perceived risk, the higher the returns that investors would expect. Now keep in mind that a buyer of a mature business that is considered low risk will expect a return of 17%, and a buyer of a mature business considered high risk will expect a return of 35%. Now, let's say that the business is expected to have cash flow in the future of $100,000 per year. If it is considered to be a high-risk business, we would discount by 35%. You can see from the slide that when you add up all the present values, it tells us the business is worth $290,000. You can see on this slide that the present value of receiving $100,000 a year from now, that is discounted at 35%, is worth $74,074 today. $100,000 received 2 years from now, discounted at 35%, is worth $54,870 today, and so on. You only go 21 years because after that, the amounts are too small to make a difference. And you can see even at 10 years, the present value is less than $5,000. Now, if you say that this business creating $100,000 of cash flow is a low-risk business, you would then use 17% discount rate. When you do that and add up all the discounted amounts, we determine that the value of the business to be $584,000. That is a big difference from the value at 35% discount. That is a total difference of $294,000, with the only change being the percent return that the buyer is expected from the purchase of the business because of the perceived risk of the business. Now, if that same business with the low risk had that cash flow increasing by 10% a year, now we can see that the present value of that business is $1.1 million. That's $518,000 higher value than the calculation with no growth. You may have heard that companies are sold based on a multiple of earnings. This directly relates to what we have already explained about present value of cash flow. If it is a high-risk mature business, you would take 100 divided by 35% to get 2.9 times cash flow. If it is a low-risk mature business, you would take 100 divided by 17% to get 5.8 times cash flow. In the examples I showed, when you multiplied the $100,000 times 2.9, you get $290,000, which comes out to what was calculated with the present value of cash flow. I've talked a lot about cash flow, but I haven't really explained what cash flow is. You can't just take the bottom line profits of the business as the cash flow of the business. First, you need to determine earnings before interest, taxes, depreciation, and amortization, or EBITDA for short. You take the bottom line profits of the business and you add back interest expense, income tax expense, depreciation expense, and amortization expense. Depreciation expense is where you take the cost of capital assets and spread that cost over the expected life of the asset. You are adding it back because it is a non-cash item. It was a cash item when you bought the asset. Now, amortization is similar to depreciation, but it relates to intangible assets, such as trademarks and patents. I'll explain depreciation much further in a separate video. Once you have EBITDA, there are more adjustments needed to figure out the cash flow. You need to adjust for any salaries or compensations that are above or below market compensations. In other words, are the owners or family members of the business receiving compensation that is higher or lower than you would pay someone that's not a family member? This also goes for a rent on a building. If the owner owns the building and is charging the business rent, is that rent at a market rate, or is it higher or lower than the market rate? If it's higher or lower, that needs to be adjusted as well. You would also take into account any capital expenditures needed for the future operation of the business. If all the equipment is old and needs to be replaced, this would impact future cash flow of the business. So, now that you can figure out the cash flow of the business, what about the risk factor? How do you figure out what the discount factor is for determining the present value of future cash flow, or inversely, the number to multiply that cash flow by? Well, this is more difficult. I'll explain the various things that impact the business risk factor in a separate video. But in the meantime, here are a few points to keep in mind. What is the dependence the business has on the owner? Is that dependence high or low? And whether there are processes or standard operating procedures in place. And is there customer concentration where the customer makes up more than 15% of the total sales of the business? And last, whether the business can keep up with technological changes into the future. If you like to get an idea of what your business could be worth, I have a software tool that has a series of questions that I go through with you that helps you determine the risks of your business from a potential buyer's point of view, and provides a range of values. Contact me if you are interested in going through this questionnaire and getting a report that it produces. At the beginning of this video, I said I would show you how to exponentially increase the value of your business. It's simple. Now that you understand how businesses are valued, it really comes down to two things. First, it is increasing the cash flow that your business is generating, and even better, increasing what that business cash flow will be into the future. And second, it is to decrease the risk of the cash flow continuing into the future from a potential buyer's point of view. So, you can see from the slide that if a business generated $100,000 a year in cash flow, and it was considered a high risk, and it would be multiplied by 3, and the value of the business would be $300,000. After improving the business, cash flow per year would increase to, say, $300,000, and we set up the business so that it would be considered a low risk, thus be multiplied by 6 or higher. Now, the business is worth $1.8 million. That's a significant increase. So, it is important to not only increase cash flow, but also it is beneficial to decrease the risk from a potential buyer's point of view. I look forward to seeing your comments and questions in the comment section of this video. If you like this video, please click on the like button and subscribe to this channel. Bye for now.